Greetings and good day, and welcome to another exciting episode of One Path to Wealth. I'm your host, Jeremy Dicker, the Hebrew Hammer. Thanks so much for being with us today. I've been asked recently, actually quite often, what makes a good financial plan? And more importantly, what makes a good financial planner? So I thought we'd talk a little bit today about those two interesting topics. And today, especially in the market that we're in and all the news and the political stuff and government shutdown and all these things that are topics that are certainly front of mind, I thought that today we'd talk a little bit about planning, financial planning, the basics of financial planning, how to select a good financial advisor, and so on. So first, I thought we'd talk a little bit about financial plans. And I think oftentimes consumers confuse products versus planning. And so what do I mean by that? I'll use an analogy. The best plan in the world without great products is just a plan that may or may not perform. So said differently, you could have the best plan in the world, thought out, well decided, lots of conversations. But if the products that you have supporting the plan don't support it well enough, that plan may not perform. The flip side, or the converse of that, is you could have the best products in the world. And absent a really strong plan, you just have really cool stuff. So when one starts thinking about financial planning or just planning in general, the way we look at things is having a set of core fundamentals that help you get to where you want to go. So the first one is goals and planning itself. What are the goals of the plan? What are you trying to achieve? Are you looking to educate your kids? Are you looking to ensure that retirement is as robust as you want it to be? That you're going to be able to replicate the income that you have today while you're working in those retirement or those golden years, in those what I like to call financially flexible years. Then you look at analyzing your situation on an ongoing basis. And again, very few consumers would do this on their own. It's usually your advisor, but making sure that you're doing a great deal of analysis on the plan. What assets do you own? Where's the income going to come from and when? When will you absolutely need the majority of that income? Are concerns around health, we're leaving an inheritance behind, part of it. And then after you've done the analysis, you begin to implement that plan. And the implementation process is a variety of things. It can be setting up the actual documents that you need, your living trusts, opening up the accounts that you want, creating accounts with specific titles. So you know one account is your mailbox money account. That's the money that comes in every month that helps you pay your bills. There's a travel account. Perhaps something that's going to support kids or grandkids or a special needs relative that is something that's front of mind. Then you've got to have review. And that review is very, very important because plans move around. All the best plans that I've seen are set in motion statically, but they end up performing dynamically. So what does that mean? That means you have all the best intentions. You set your plan up. You've got a reasonable expectation for rate of return, and then an 0809 happens, or COVID happens, or the tech bubble bursts, and that happens. And now all of those plans that you've set in motion are out the window, or should they be? Because here's what is very important to understand. In the 30 years that I've been in practice, what I will tell you is very seldom you own assets that are poor assets. Very seldom is there an asset that you're putting in your portfolio that is just so awful that it goes to zero or shouldn't have been there in the first place. Most of the time, if you've done the due diligence, if your advisor has been advising, if that advisor has been selecting the proper assets relative to your portfolio, relative to your risk tolerance, most of the times you're going to have very good, strong things in your accounts. But what's key, what's fundamental, what's paramount is the ongoing analysis and review, and then ultimately making adjustments and having good conversations around what it is that you want to have happen and when. One of the statistics I read many, many years ago was that 92% of portfolio performance comes from proper asset allocation. 92%. 8% is chance. You bought Google or Tesla or whatever, and it went from X to Y. But 92% of the time, it's how well did you allocate your portfolio in a way that is consistent with your goals, objectives, and your risk tolerance. And those are really, really keys, because I think what's happened over the years is this idea of conservative investments versus aggressive investments have gotten very muddled. 30, 40 years ago, someone would retire our grandparents, our parents would retire, and they'd sit down with their budget and they'd buy bonds or other fixed income securities that would just give them a static free of income that would come in every month, and they didn't have to think about it. It was a set it and forget it. Well, with interest rates being held at such low levels for so long, yield and bonds and fixed income products weren't as attractive for the everyday consumer, and candidly would oftentimes miss the mark relative to what was needed from an income perspective. So the question is, okay, well, I'm 60 or 65 or 70. I don't have the risk tolerance I had when I was 35 or 40. So what do? Well, you have to look for alternative investments. And I don't mean alternatives in that sense of the word, but I mean alternatives just from, you need to look for alternatives for yourself and identify the proper asset class and the proper investments for yourself that meet your risk tolerance, that provide you the income that you need and provide you the support that you need. And this is where the secret sauce starts to be made. It's where that secret sauce starts to really bubble up and come together. And what do I mean by that? Well, you look at the market, you look at the landscape, and you assess what's most appropriate for you and how much risk you're willing to take, and what is your appetite for risk. Are you willing to see your portfolio go down by 30% for a short period of time? Or is 10 the max that you'd be comfortable dealing with or undergoing? Are you willing to take more risk with part of your portfolio and keeping the balance in a lower risk setup or structure so that you can ensure that you don't see those volatile swings up and down? And that's all part of the fundamentals around financial planning. It's all part of what I said earlier today, that the best plan, the most thought out plan, the most well-documented plan, if it doesn't have great products supporting the plan, it likely will not perform. And there's a lot of great companies out there producing phenomenal products. And every now and again, there's that one product, that one structure that isn't right for you, and that can drive concern, fear, and other things to your accounts that don't allow you to have the same kind of financial success that you would want to have in your portfolio, in your life, when you're at that period of time. And by the way, the same is true when you're working. Ultimately, when you're investing money or deploying capital and you're being a good steward of the cash that you have, the things you should be looking at and the things that the consumer should be looking at are things around how much money can they put away every month, every year, every quarter, every half year. What does that look like? What's the purpose for the dollars that they're putting away? Is it college education? Is it retirement? Is it a combination of both? How are they looking to protect their risk? God forbid something happens and they step off a curb and get hit by a bus and aren't coming home that next day. How's the family set up? Is the family going to be okay? Have you addressed your living trust documents and other things to ensure that guardianship of your children has been discussed and agreed upon? And if there's been any changes, has there been a falling out with a relative that makes you feel like, oh, maybe my sister or my cousin or my stepsister isn't the best choice, or my mom isn't the best choice? Who is that secondary line of defense that's going to protect those kids until they become of age? And so when we think about financial planning, it's encompassing all of those things. And it's the idea that you could go out and buy this magic product. And, today there's so many things that are being talked about with the AI boom, with gold and precious metals, the technology sector being white hot this year. And is that buying a product, is buying Tesla or buying gold or buying Google or whatever it might be for you, is that a product or is that a plan? Well, those are assets, those are securities, those are things that should be in your plan, but they're certainly not a magic bullet. And when you go out there and you bet it all on the ponies, realize that's the difference, the fundamental difference between investing and gambling is that. And the real key to successful investing is having a strong plan that mirrors whatever your expectations are. All right, so then we talked a little bit about a plan. So what about a planner? What about finding a financial advisor that helps address the concerns that are ongoing and just for things that are out there? Again, we've got so much going on in the world today. It's very easy to be blinded by the noise, but that shouldn't take you away from developing a strategy and a plan that helps you achieve your goals and objectives. So there's a lot of books out there, How to Hire a Financial Advisor for Dummies and all these other ones. And I think fundamentally, the biggest key to finding a financial professional, to finding a CPA, an attorney, whoever, is asking questions around what those individuals' expectations are and if they mirror or mimic what your expectations would be. So some questions to ask your financial advisor or your trusted advisor, so to speak. How long do they plan on working and being actively engaged? Are you, Mr. Advisor, going to be my advisor, or are you handing me off to somebody else? And if you are handing me off to somebody else, that may be fine, but what's that person's core competencies and how many people are they now working with? What's the average length of time your client has been with you? That's something that can be very important. And if it's a new advisor that's new to the business, you're going to have that conversation. It's going to be more around what are their goals and expectations around their practice as they're building their respective businesses. And then lastly, do they have a tilt one way or the other from an investment perspective? I like to oftentimes say that we're stylistically neutral. When we look at managing money for a client, it truly is about best in class, best in services, things that are most appropriate for the clients, given what their goals and objectives and dreams are. And we're not going to subscribe to one specific style or the other. We're going to look to address the investment concerns, performance concerns, risk concerns relative to what that client's needs and expectations are. And I think that's a very, very important thing to focus on, because oftentimes you'll come in, meet an investment advisor or financial professional, or let's even look at any other form of trusted advisor, an attorney, and they've got a specialty of estate planning. Well, is that estate planning attorney going to be the best for your corporate needs? Maybe not. Maybe they will. Maybe they've got strong knowledge in those areas, but if it's not something that's their core competency, are they going to be the best suited to address those issues? Accountants, same thing. They do taxes. They file those tax returns, but very seldom are they, in most situations, CPAs that are going to help you with your plan. Now, some are. And those ones that are helping you with your planning, those are, phenomenal and critical to someone's overall financial success. But if your accountant is just simply filing a return and they're not providing you with any guidance, they're not asking you questions about what's important to you, they're just taking your information and filing it, that's no different than a financial advisor that you go to that's taking your information, talking a little bit about your investments, moving over your money, and that's where it ends. When in reality, the best advisors out there are the ones that are engaging and asking you, the consumer, questions about what's important to you. How long do you expect to live on this money? Do you anticipate any form of an inheritance? Are your parents or grandparents or anyone else going to become financially reliant on you in the future? And if so, how should we consider or address that in the financial plan? Do you have a special needs relative that should be considered in this planning? And if so, what are you planning on doing for them? Do you have a trust set up? Are you funding that trust? Are you looking at life insurance so to guarantee that there's enough capital to provide for that special needs relative if and when you leave the earth prematurely? So I think those are the kinds of things that you've got to be speaking to your clients about if you're an advisor. And from a client perspective, those are the questions that I'm going to want to be asked. I don't want someone just coming up and saying, how much money do you have? Are you comfortable in tech? Are you comfortable in global markets? Give me your money and let me invest it for you. I don't think that does the job. The real job of an advisor in any area of advice is to ask questions. And, I always say the good Lord gave us 2 ears and 1 mouth for a reason. You're supposed to listen twice as long as you talk. And so I think an advisor really needs to do that. And the client doesn't need to necessarily know all the questions to ask, but they've got to have a good feel of the person that they're working with. They need to understand that there's certain things that person may recommend that they don't understand or maybe not even agree with, but they're giving advice. And ultimately, the client has the choice to take it or not. But you want to receive advice. You want to have a dialogue, you want to have a conversation. And from an advisor's perspective, on the other side of the line, it's the same thing. The expectations from the client need to be that client is going to take the advice that's being provided within reason, of course. It's got to feel right and be the right thing for those individuals that are choosing to invest with you. But fundamentally, it's got to be a good match. And that's really what it comes down to. At the end of the day, making sure that your clients and the consumers that are choosing to hire us as advisors are comfortable with every aspect of the things that we are working and delivering for them individually. And on the consumer side, it's the same thing, making sure that they're asking the questions and feeling right about the direction of the planning and the tools and all of the things that are being discussed. What's very, very core and fundamental in all of this is making sure that any plan that's put in place, that you're addressing all of those questions along the way. And today we've got so many tools out there. There are all kinds of online web-based tools that allow you to work on your living trust or your prenuptial agreement or your corporate documents. And they're great if you already know the questions to ask the system. And AI has certainly come a long way and will continue to be a phenomenal tool that's going to allow people to get more information quicker, faster, ask themselves some of those very own questions. But what I do think is key and what's paramount today is that the advisor has to really bring that out of the individual. So what do I mean by that? Well, as I said earlier, are you an aggressive or a passive or a conservative investor? I don't think today the world works that way. I think the question really needs to be, what's your appetite for risk in your portfolio? Are you comfortable with a radical decline if you know that those assets are proper and they're properly suited? Are you comfortable if the money pulls back 20 or 30% for a period of time? Or does that make you so uncomfortable that you'd rather stick to something that is more risk adverse, that has less volatile movements in the portfolio that's designed, and so on? Then also, are taxes a concern? Do you have the economic outlook that most people would have relative to the assets and taxes that you're buying and that you're utilizing? And if taxes are a concern for you, making sure that your portfolio addresses ultimately those tax concerns. And then again, income. Are you at a point where you want to have income, or today you don't really need the income? You are comfortable just growing those assets, building them along the way, and so on. And then lastly, to close out this piece, I think it's the risk aspect. Do you have the insurances in place to ensure that your kids are not going to have to fund your lifestyle when you're in retirement? Do you have long-term care to ensure that the back end of your retirement is insured, which allows you to spend, in theory, more money while you're in your active and enjoying years, because you know that the back end of your retirement has been insured so that no one else is going to be responsible to take care of you financially or otherwise while you're in those golden years. And then while you're younger, you have life insurance in place to ensure that your surviving spouse, should something, God forbid, happen to you, has enough capital and enough resources to ensure that the kids can still do their ballet lessons and your son or your kids can play club sports and can do all the things that are important to them, the things that you did while you were actively involved and alive and part of that household, traveling and all of those other things. And this idea from a risk perspective that, I'll use the wife as the example. Oh, my wife will, meet a rich guy. She can rely on her parents. As a father of two, if some man was, or a young man was courting my daughter and said that I'm not worried about working hard or developing a plan to protect, your daughter's future because, God forbid something happened, she can just rely on you there, sir. That would kind of bother me. And I think that when you think about risk mitigation strategies, and insurance is certainly a core component to that, the idea that it's going to be somebody else's problem is ridiculous when you can solve it on your own. And financial planning and risk planning is about solving those problems and understanding that it isn't somebody else's problem. Financial planning is not somebody else's problem. Your financial lot in life is not somebody else's problem. And if you don't have what you want to have in retirement or right now, that is something you can choose to correct. You can choose to not drive the really expensive car. You cannot buy the most expensive house, one that you really have to stretch because it's not appropriate. You don't have to travel the most expensive trips that you can. You can live within a budget and set of means that allow you to have prolonged success both while you're working and when you're not. And one of the things that we take to our clients is exactly that attitude. Look, when people say, when I ask them the question, hey, when do you want to retire? They say tomorrow, ha, ha, ha. My answer is, we can show you how to do that. It's going to be very expensive. You're going to have to really commit to a strong strategy of putting away a lot of money every month, every year, every quarter, but we can get you there. That's the right answer. Because the reality of it is we can't. It's what kind of fundamental changes do you want to make? What kind of commitments do you want to make? What do you want to do with a budget to ensure that you are putting away the maximum amount of money you possibly can to get yourself into a place where you can have that choice to retire when you want, to be financially free, financially flexible when you want. And I think those are the key conversations and the key thoughts. Because at the end of the day, the conversation is just that. But you have to have those thoughts. You have to really be willing to address those considerations and those concerns to make the best possible decisions around the dollars that you have that you can put to work today. So in closing out this segment of One Path to Wealth, I think what's important to take away from this conversation this morning is that it's very important to have a very clear understanding of what your budget is, what your goals and objectives are, both while you're working and when you're not working, and then who you need to be planning to protect for, whether it be an extended relative, whether it be your current kid, spouse, whatever it might be, making sure that you're addressing all of those current concerns, that you're clear, that you document it, and most importantly, that you hire somebody that you feel like represents your best needs, listens to you, hears you, and is communicative and is going to be there for you when this plan is needed and when this plan needs to be put in place. And then most importantly, when the plan is in place and it is working, is there to actively review and make ongoing adjustments as needed. And most importantly, have those conversations when you need to have them. So with that, I am your host, Jeremy Gicker, the Hebrew Hammer. Thank you for joining us for another exciting episode of One Path to Wealth. If you like this episode and more, please click like on your box and remember to subscribe to our blog as well as the podcast. Have a great week.
Thank you for listening to One Path to Wealth podcast. Click the follow button to be notified when new episodes become available. Visit our website at www.onewealthmgmt.com or give us a call at 855-663-9584. And don't forget to click the follow button to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of One Wealth Management. The content has been made available for informational and educational purposes only. The content is not intended to be a substitute for professional investing advice. Always seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your investment planning. Investment advisory services offered through One Wealth Capital Management, LLC, an SEC-registered investment advisor. Insurance solutions offered through One Wealth Management, Financial and Insurance Services, Inc.